Very good morning to all of you. Uh, Today with another session on tax accounting, and before starting, I convey my deep sense of gratitude to the Indian Academic Researchers Association and specifically Dr. C. Paramasivan, the Honorable President of Iara, and other team members. And without wasting much time, I'm directly going to my topic. This is specifically goods and service tax, that is GST, the biggest transformation of indirect tax structure in India. Myself, Dr. Pranam Dhar, former head and chairperson, postgraduate Department of Commerce and Management, West Bengal State University. And today my presentation agenda is divided into 4 steps. First, about GST basics, that is what is GST, why GST, how things changed, and then to GST concepts, which includes registration, invoice matching, and returns. Thirdly, to implications, that is input credit on expenses and illustrations. And fourth, what should I do today, that is business practices and technology. Let's start with this famous quotation from very ancient days finance minister, but famous, known to all of us, Chanakya or Kautilya, who was a very famous revolutionary figure in Indian financial system. According to him, king must collect taxes from honeybee. It should be enough to sustain, but not too much to destroy. That means when we see honeybee collects honey for its sustenance only, but too much of honey is not collected so that it disturbs others. So king should collect tax for the sake of fund generation, which will be utilized for the purpose of public welfare, but it should not be at the cost of anybody, at the cost of destruction of others. So before going to the GST directly, let's go to the history of tax. The word tax is originated from the Latin. The word tax is originated from the Latin word taxere, which means to estimate. A tax is not an optional payment for donation, but it's a passer to contribution, which mentions by the legislative authority, and otherwise any contribution imposed by the government, whether under the name of toll, tribute, import duty, custom, excise, subsidy, aid, supply, or other name indicated by the law of tax. The first known system of taxation was in ancient Egypt around 3000 BC to 2800 BC in the first dynasty of the Old Kingdom. In 1922, the country witnessed a paradigm shift in the overall Indian taxation system. Setting up of administrative system and taxation system was first done by the Britishers. Broadly, there are 2 types of taxes, namely direct and indirect taxes. Taxes in India are levied by the central government and the state governments. Some minor taxes are also levied by the local authorities such as municipality or local council. The authority to levy tax is derived from the Constitution of India, which allocates the power to levy various taxes between center and the state. Time to time change the millage of tax system in our country. Now, let's go to the historical snapshot of the tax system reforms in India with special reference to goods and service tax. In 1994, a report of L.K. Jha committee which suggested VAT, value-added tax. In 1986, introduction of new form of VAT called mod VAT or modified value-added tax. In 1991, Chelia committee suggests VAT or GST and suggestion accepted by the government. In 1994, implemented the service tax. In 1999, established the Empowered Committee on State VAT. In 2000, implementation of uniform floor sales tax rates and abolition of tax-related incentives granted by states. In 2003, Haryana government starts VAT. In 2004, meaningful progress towards VAT or centralized value-added tax. In 2005 and 6, VAT implementation in more than 26 states. And in 2007, first GST draft norms released by Mr. P. Som in January. In 2007, again, Finance Minister announces for GST in budget speech. In 2007, CST, Central Sales Tax phase out, start in April 2007. And in 2007, joint working group formed and report submitted. In 2008, EC Executive Committee finalizes the view of GST structure in April 2008. Now it took long 10 years, and finally GST Act, Goods and Services Tax Act, was implemented with effect from 1st April 2007. Now the countries which have already implemented GST issued and levied, India is the among 193 countries, UN member states. Already India is the 163rd country, and 41 member states do not implement VAT or GST as follows. And India is the 163rd country of the world which has already implemented GST with some new change or modification. Now, before GST coming into existence, what was the existing tax structure and proposed tax structure? Existing tax structure was divided into two parts: direct and indirect. And direct tax comprised of income tax and wealth tax. Indirect tax comprised of central tax and sales tax. Now, state tax, there is a typographical error: central tax and state tax. Among the central taxes, there were three types of tax: excise, service tax, and customs. Among the state taxes, there were value-added tax and entertainment tax, luxury tax, etc. Now, under the proposed and effective GST structure, there are two types of taxes. One is direct, another is indirect. Direct tax includes income tax and wealth tax. Indirect tax includes interstate and interstate. Intra means within the state, and inter means between the states. Within interstate tax, there are CGST, that is central portion, SGST, that is state portion, and IGST, that is integrated one, which are not falling into these last two groups. And within the interstate GST, there are only integrated GST. Now, what are the regulatory framework of GST? A new setup by Government of India named as GST Council. The GST Council consists of Union Finance Minister as chairman, the Union Minister of State in charge of revenue or finance, and the minister in charge of finance or taxation, or any other minister nominated by each state government. All decisions of the GST Council will be made by 3/4 majority of the votes cast, and the central shall have 1/3 of the votes cast, and the states together shall have 2/3 of the votes cast. What will be out of GST? The following will be out of GST. Still now it's out of GST, that is levies on petroleum products, levies on alcoholic products, taxation, lottery and betting, basic customs duty and safeguard duties on import of goods from India into India, entry taxes levied by municipalities or panchayats, entertainment and luxury taxes, electricity duties or taxes, taxes on vehicles, stamp duties on immovable properties. Now, who is the taxable person in case of GST? It will cover all types of person carrying on business activities, that is manufacturer, job worker, trader, importer, exporter, all types of service providers, etc. Then if a company is having 4 branches in 4 different states, all the 4 branches will be considered as taxable persons. Nobody will be escaping under each jurisdiction of state GST. And all the dealers or business entities will have to pay both the types of taxes on all the transactions. A dealer must get registered under CGST, as it will make him entitled to claim ITC of CGST, thereby attracting buyers under B2B transactions. Importer have to register under both CGST and SGST as well. Now, understanding GST, there are 5 easy steps. Firstly, GST or Goods and Service Tax, a single unified indirect tax, aims at uniting India's complex taxation structure as a one nation, one tax regime. Then destination-based tax on suppliers of goods and services. It will be levied on supplies with seamless flow of credit for both goods and services till it reaches the end consumer. Then only the value addition will be taxed, and burden of tax is to be borne by the final consumer, and GST would replace indirect taxes. That is, many of such taxes, that is central excise duty, CST and VAT, entry tax and octroi, surcharges and cess levied by state government, etc., will be merged into single tax known as goods and service tax. So why GST? Because of simple tax structure, eliminating cascading effect. What is cascading effect? You see, there are multiple taxes paid by a single taxpayer. For example, the iron and steel industry produces steel sheets, which are used as raw materials in the automobile industries, and iron and steel industry manufacturer pays previously paid tax on the steel sheets, and again the manufacturer of car which uses these as raw materials had to pay tax on the finished product, that is car, and the taxes are doubled. And consumer had to bear these double taxes. Now this cascading effect is removed in the form of input tax credit. That means iron and steel manufacturer will get back the return of input tax credit, in the present GST system. Thirdly, it will be a technology-driven system, total driven by the technology, and as it is so transparent, everything will be clear. All the taxes, all the sort revenue will be coming to the government, both to the central and state governments, and that will increase revenue in the hands of government, which will be utilized for the welfare of the general people. And why GST? There are some perceived benefits to trade and also to consumers. To trade, it is in the form of reduction in multiplicity of taxes, mitigation of cascading double taxation, more efficient neutralization of taxes, especially for exports, development of common national market, simple tax regime, and fewer rates and exemptions. Now to consumer, there is simple tax system, reduction in prices of goods and services due to elimination of cascading of taxes, uniform prices throughout the country, transparency in taxation system, and increase in employment opportunities. Now some highlights of GST are there, like the common threshold limit across the country, continuity of tax credit across the supply chain, reaches the consumer, then elimination of tax cascading effect in the supply chain, then PAN-based registration, and lastly on supply tax liability in case of instead of removal or sale. Then there are other factors also, that is valuation method broadly as transaction value, branch transfers, taxable and credit eligibility, tax credit eligibility on inward supply of goods or services for interstate transaction, no declaration forms like CDE, etc. Simple tax structure like the removal of the present, that is current tax structure already mentioned. The tax component of GST comprises only three, that is CGST stands for central GST. This is applicable on supplies within the state. Tax collected will be shared to center. SGST means state GST. This is applicable on supplies within the state. Tax collected will be shared on state and shared to state. And IGST, this is the important part because India has only built the IGST Act. The enactment of IGST Act has not been made by any other country of the world. IGST stands for integrated GST. This is applicable for interstate and import transactions. Tax collected is shared between center and state. Now you see the determination of charge in case of inter and interstate. There is an example. If Karnataka is the location of the supplier and place of supply is within Karnataka, then it is divided between central government and state government of Karnataka only. No other state is levied any tax except Karnataka. But if the Karnataka is the location of supplier and place of supply is Tamil Nadu, this is known as interstate, that is between the states. Intra is within and inter is between the states, and both the states will be getting the proportionate amount of CGST, and that's why it will come under the purview of IGST. Then there are some concepts of GST like registration, return filing, invoice matching, and input tax credit. You see, for registration, there are some threshold limit for regular dealer in Northeast India. The aggregate turnover it exceeds if exceeds 9 lakh for registration, 10 lakh for payment of tax. Well, for the rest of India, aggregate turnover exceeds 19 lakhs for registration, 20 lakhs for payment of tax. And there is a composition scheme. In this scheme, composition levy is aggregate turnover does not exceed 50 lakhs. Then this is the registration process. All the dealers have to get registered with the following things, following required information like basic company details like the name, address, etc., certificate, PAN, PIN, mobile number, photograph, etc. And the application will be registration in every state. And after that, the state will be given the dealer will be given this registration number. And there are lots of GST returns have to be filed, although the process has become simpler now. Like GSTR 1 for outward suppliers, which is to be filed within 10th of next month. GSTR 2 for the inward suppliers, which is to be filed within 15th of the month. GSTR 3 for monthly returns. GSTR 4 for compounding taxpayers. GSTR 5 for foreign non-resident taxpayer. GSTR 6 for input size service distributor. GSTR 7 for TDS, GSTR 8 for annual returns. And this is the mechanism of filing GSTR 1A, 2A, 3A, etc. And there is a payment mechanism. And you see inward supplies register, book for Supercars Limited, particular company, and outward supply register. This company maintains these two inward and outward supplies register, and there are tax invoices based on that. And you see, these are the types of returns for a regular dealer: GSTR 1, 2A, 2, GSTR 1A, 3, 3A, and GSTR 8. And GST return process is to be, first of all, a dealer has to get a GST number, that is GSTN, and the GSTR1 has to be filed for outward supplies made by the taxpayer for the 10th of the next month, GSTR2 for the inward supplies received by the taxpayer within 15th of the next month, GSTR3, that is GST return for the month with tax, which is to be filed within 20th of the next month. And you see, availing ITC input tax credit, when seller pays tax to the government, buyer gets input credit. And here you see, buyer gets input credit only if seller pays GST. Now, transition registration in case of migration, and automatic registration, and first provisional and then final registration in case of migration. Registration process and forms existing. You see the mechanism and with the GSTN. First, form number GST registration 21, then to registration number 20. Then there is a flow chart, data flow diagram. Then registration 6, registration 23, and so on. This is for existing dealers registration, and this is for these are the registration forms. GST registration 7, it is for application for registration as tax deductor or tax collector at source. GST registration number 8, it is order of cancellation of application for registration as tax deductor or tax collector at source under section 21. GSTR registration number 9, application for allotment of unique ID to United Nations bodies or embassies. GST registration 10, it is application for registration for non-resident taxable persons. So it is an universal format adopted by all the countries. Now there are certain amendment of registration details for which the same mechanism is to be followed. This is a flow diagram. For cancellation of registration, there is a flow diagram. Registration, revocation, cancellation. Cancellation, if the registration cancellation is to be revoked, then there is also the same mechanism, the same flow chart. All the data here given. Due to lack of time, I am skipping. And for mandatory person, the taxable person carrying on interstate supply, businesses liable to pay tax under reverse charge, input service distributor, sellers on e-commerce platforms, casual and non-resident taxation persons, agents supplying on behalf of taxable persons responsible to deduct TDS, and aggregators supplying services under his brand name. All for them registration is mandatory. And now coming to GST accounting, Tally has provided a solution for a qualified GST Suvidha provider, that is GSP, and under this there are systems like for IGST, CGST, and SGST. Now, input tax credit will not be credited to bank. This is the important point. It will be available in an electronic ledger, which can be adjusted against tax liability. So, this is the GST technology-centric solution. Let us consider two aspects for law for illustration. Seller needs to pay taxes before buyer can take input credit. Input credit is available for direct and indirect indirect purchases. So, what is the consequence if the GST is not paid? There are certain consequences of non-compliance, that is GST not paid and GST return not filed. First, the credit rating will be affected. Non-compliance will affect the company's credit rating, which is visible to all. Bad rating may impact customer and supplier confidence in the company, impacting business. Then late fee and interest. Failure to furnish returns will lead to quarterly or monthly payment of late fee ₹100 per day for every defaulter day, subject to a maximum ₹5,000. Annual return if not filed ₹100 per day for each day of each defaulter day, subject to a maximum of 0.25% of the aggregate turnover. Interest on total tax due, rate yet to be notified. Then for cancellation of registration for regular dealer, if returns not furnished for consecutive 6 tax period. For composite dealer, if returns not furnished for 3 consecutive tax periods. Now, this compliance discipline is important, because if you miss a month's filing, you can't file for the subsequent month, because the you see in the picture the for the next month your column is blocked, so you cannot pay unless tax pays for the previous month with fine and penalty. The next month block will not open up, and these are the business implications for you. Difference between VAT and GST. GST is to be filed each and every month. Need to upload every transaction. Invoices of supplier and recipient need to match. Can be availed only when invoices are matched, and seller pays tax liability. Available for all inward vouchers which are used for the furtherance of the business. Now, input tax credit on expenses. There is an example. You see the pre-GST era gross profit in both the cases, and post-GST era gross profit in both the cases were 5 lakhs, but indirect expenses are travel expenses 90,000, office and go down 90,000, printing and stationery 90,000, repair and maintenance 90,000. So in pre-GST era it was 4 lakhs because there are no input tax credit. Now input tax credit is 40,000. So from 4 lakhs expenses becomes 3,60,000 in post GST era, but it was 4 lakh in pre GST era. So in post GST era, the net profit increased from 1 lakh to 1,40,000, and this is the benefit of GST availing. Now, how do I prepare for the change? For example, this is another example. You see there is a timber maker which is termed as A, who produces and supplies final product, that is timber, to the furniture maker. His cost of production was 100 and CGST was 10. ST was 10. Total was 120. But to the furniture maker, when it comes at 100, because CGST and SGST both are refunded to the timber maker in the form of input tax credit. Then with that he adds another 100. It becomes 200. And again SGST and CGST at the rate of 10% is 20 each, so it comes to 240. But when it goes to the furniture retailer, that is C, from furniture maker, that is B, again input tax credit of rupees 20 each for CGST and SGST is being given to the furniture maker, and ultimately the furniture retailer gets his at 200. With this he adds 100 as cost of production, and again 10% CGST and SGST, so 30 plus 30 60. So instead of being 400 or more, the total cost of production to the final consumer is 360 plus normal margin, because here again the from the when the consumer accepts it, the input tax credit, when the consumer pays for purchase, the input tax credit of rupees 30 each for CGST and SGST is returned to the furniture retailer. So ultimately this is the input tax credit effect, and these are some more examples. You need to homework with this. Now this is the tax scenario of GST already mentioned. There are some impacts, both positive and negative impacts of GST. Positive impact starts with transparency in the taxation system. It reduces the price instead of increasing it. It generates employability among the youth, especially self-employability. MSME sector is much benefited. Medium and small scale industry is much benefited with GST. Now, in GST accounting, what should do? We should be acquainted with GST accounting, because if you go to your tally, that is computerized accounting part, this increases employability, because when you learn how to act with GST accounting, you go to the features, that is F11. Then from there are three options: F1, F2, and F3. Go to F3, that is statutory and taxation. Then set, prepare, and follow style GST return, and you click on yes, and then you give, just like the picture, you give the GST registration number and the company registration number, and then accept is as yes. Then you are able to create purchase ledger with GST. To create ledgers under the purchase account group, go to the gateway of tally, accounts information, ledgers, create. Then number one, enter the name for the purchase ledger as purchase. In the under field, select the purchase account from the list of groups. Set inventory values which are affected to yes if you maintain inventory. Set the field GST applicable to yes under statutory information, and accept with yes. Now, this is the literacy of GST accounting, very brief because due to lack of time, but there are certain negative impacts of GST also. There is a confusion. Lots of circulars, lots of returns, lots of change of rate. There are lots of returns. India is the only country where there are 4 or 5 rates going on. And due to the lack of literacy, you have to engage a chartered accountant or a GST auditor. So the huge compliance cost is there, and execution of certain clauses, that is non-compliance, may lead to arrest. So there is a huge problem. It leads to some more experimentation. But another negative impact of GST is confusing term, where double tax is charged in the name of a single taxation system. A business will be indirectly controlled by both center and the state. In all tax related matters, the state will lose autonomy to charge the tax rate, which will be regulated by the GST Council. You see, that's the reason, because that's why the two major things, that is petroleum products and liquor products, are not administered under the GST, and both center and state are taking benefit of it. State is taking more benefits rather than the center. State is taking more benefit rather than the center, and that's why the petroleum and liquor related products are not being included in the GST as yet, because the state is getting more benefits than center out of these products. Most of the indirect taxes would not start coming under GST. The central excise tax is levied at the time of manufacturing, but GST is levied till the selling stage. Most of the manufacturing states may incur losses, but the government has proposed to compensate for those losses for a period of 5 years. So under conclusion, we can say the study in our deliberation focuses only on why GST for India. More than 150, we have already shown you that 163 countries of the world are smoothly running the GST system, and this GST has increased their GDP. Although this is a pre-pandemic era, for the post-pandemic era, what will be the impact? Still yet not measured, or somehow not measured. So I'm not coming to that issue. And if the GST system is implemented properly in India, revenue and GDP will increase, and employability will be generated among the youth to a larger extent. With this, thank you all. And now I stop sharing. Now open the floor for discussion. So if there is any question, you can ask. Otherwise, I'll end the meeting. Should I end the meeting? There are lots of people like research scholars, Mr. Shayan Boshu. Do you have any question? I think no question at all. So I am ending meeting for all.